First, welcome to our deep dive on the 2025 tax shock and why relying solely on official government calculators can be risky. In this video, we will explore smarter ways to estimate your taxes early so you can manage cash flow, adjust withholding, and optimize year-end decisions. We will compare tools, walk through a DIY spreadsheet approach, and show you how to forecast tricky year-end income like dividends and capital gains. Stay tuned for quizzes to test your understanding, and make sure to watch until the end for key takeaways and a helpful checklist. Next, here is our agenda. We will start with why official calculators can mislead, then note what changed in 2025, especially items that impact early estimates. After that, we will compare official tools to alternatives and walk through a step-by-step DIY spreadsheet. We will also cover when paycheck calculators shine, how to forecast unearned income, and a December data checklist. Along the way, we will include quick quizzes to reinforce the most important points. Before we dive deeper, please note this important disclaimer. This content is educational and not tax, legal, or financial advice. Tax rules can change, and your personal situation may require professional guidance. Always verify current year figures and consult a qualified professional before making decisions. Now, why can official calculators be risky? Historically, some government calculators have lagged in updating after new laws or IRS guidance. If your estimate uses outdated assumptions, it can distort withholding, cash flow, and year-end planning. Meanwhile, vetted third-party tools and well-maintained spreadsheets often incorporate changes faster, improving the timeliness of your estimate. This is especially important in years with significant inflation adjustments or rule updates. Moving on. 2025 brings another round of inflation adjustments to rates and thresholds. As an example, sources indicate the standard deduction for single filers may be around $15,750. You should verify the latest official figures before relying on them. Year-end planning remains crucial, including tax loss harvesting, timing of charitable giving, and potential Roth conversions. The biggest swing factor for early estimates is often unearned income, such as dividends and mutual fund capital gain distributions. Accurate December forecasting will make the difference between an unexpected tax bill and a smooth filing season. After that, let's compare official calculators to alternatives. Official tools are free and familiar, but can experience slower update cycles and offer limited functionality for complex situations, reducing your ability to test scenarios. On the other hand, well-built DIY spreadsheets and vetted third-party calculators can incorporate new laws more quickly, expose assumptions transparently, and support robust what-if modeling. The trade-off is that DIY spreadsheets require time and a learning curve. Next, let's build a DIY spreadsheet workflow. First, gather inputs such as W-2 wages, year-to-date withholding, any other ordinary income, expected bonuses, pre-tax deductions, and your filing status. Second, apply the standard deduction for your filing status. For example, single filers may be around $15,750 in 2025, but you must verify the latest figures. Compute taxable income as ordinary income minus the standard deduction, not below zero. Third, model progressive brackets with a separate table of thresholds and rates that you can update each year, and tax income by layers. Fourth, incorporate other taxes and deductions as needed, like self-employment tax if applicable, net investment income tax thresholds if relevant, and any credits. Fifth, create forecast lines for unearned income and update them in December with estimates from brokerages and fund companies. Sixth, reconcile your projected liability with year-to-date withholding and any planned estimated payments or extra withholding. Seventh, run what-if scenarios for timing of bonuses, increasing pre-tax deferrals, performing a Roth conversion, or executing tax loss harvesting. Eighth, document sources and dates so you can quickly refresh when new guidance appears. Finally, sanity check your spreadsheet by comparing results with a vetted third-party calculator. Meanwhile, this sequence diagram shows the estimation workflow. The taxpayer starts by entering wage information into a paycheck calculator to get wage-only estimates. Then, they update the DIY spreadsheet with current law and progressive bracket tables, incorporating the standard deduction figures. Next, they validate results with a vetted third-party tool, looking for consistency. Finally, they produce a plan with action items, including adjusting withholding, tax loss harvesting opportunities, possible Roth conversions, and timing of charitable contributions. Throughout, they verify 2025 figures and update December forecasts for unearned income. Now let's cover paycheck calculators. These tools are excellent for ordinary wage-only situations and typically reflect current withholding tables once payroll providers implement updates. They are useful for testing W-4 changes, adjusting additional withholding, and exploring bonus timing. However, they are not designed for unearned income, stock sales, complex credits, or multi-source situations. In those cases, you should pair them with a DIY spreadsheet or a robust third-party calculator. Then, let's talk forecasting unearned income. Start with prior year distributions as a baseline. In November and December, consult fund company year-end estimates for dividends and capital gains. For dividend estimates, use exchange-traded fund dividend history and current indicated yields, adjusting for any position size changes. Pay special attention to mutual fund capital gain distributions, particularly in actively managed funds. To avoid surprises, coordinate tax loss harvesting and the timing of charitable giving. Finally, remember safe harbor rules. Many taxpayers avoid underpayment penalties by paying 100% of the prior year total tax, or 110% for higher income households, subject to current regulations. Always verify current thresholds for the year. Next, this pie chart illustrates a hypothetical income mix, with wages at 70%, dividends at 15%, capital gains at 10%, and interest at 5%. These figures are placeholders. Your actual mix will differ and should be based on real account statements and updated December estimates from your financial institutions. After that, use this December data checklist. Pull your latest pay stub for year-to-date wages and withholding, including any additional withholding amounts. Confirm planned bonuses and how your employer withholds on supplemental wages. For dividends and capital gains, rely on brokerage dashboards and fund provider estimates released in November and December. Gather bank statements for interest income and consider changes in rates during the year. If you are considering a Roth conversion, simulate the tax impact before acting. Collect charitable receipts and decide whether to bunch deductions or use a donor-advised fund. Reconcile estimated tax payments with bank records and the IRS, and note all payment dates. Finally, compile state and local tax payments while being mindful of applicable limits. Now let's test your understanding. The question is, which tool is most accurate for modeling ordinary wage withholding on your next paycheck? The options are A, an official government tax calculator, B, a paycheck calculator from a payroll provider, C, a DIY spreadsheet with last year's brackets, or D, a mutual fund's dividend announcement. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, a paycheck calculator from a payroll provider. These calculators are designed to reflect current withholding logic for wage-only scenarios, making them highly accurate once payroll systems are updated. Official calculators and last year's DIY assumptions may be out of date, and a mutual fund dividend announcement is unrelated to paycheck withholding. Next question. What is the most common source of error in early tax estimates for 2025? The options are A, forgetting your filing status, B, not forecasting unearned income like dividends and capital gains, C, using a paycheck calculator for wages, or D, entering your employer's address incorrectly. You may pause the video now to consider your answer. We will reveal the correct option in the next section. The correct answer is B. The most common source of error in early tax estimates is failing to forecast unearned income, such as dividends and capital gain distributions. December forecasts are crucial because these variable items can shift your final liability significantly, even when your wage estimates are accurate. Now, here are the key takeaways. First, update speed matters, and alternative tools often reflect new laws faster. Second, a DIY spreadsheet provides control and transparency. Third, paycheck calculators excel when you are modeling wage-only scenarios. Fourth, forecasting unearned income carefully in November and December is critical. Finally, always verify 2025 figures and document your assumptions. Finally, let's put it all together. Start early to manage cash flow and avoid surprises. Use the right tool for the job. A paycheck calculator for wage-only estimates, a DIY spreadsheet for detailed control, and a vetted third-party tool for validation and complex scenarios. Refresh your December forecasts for dividends and capital gains and cross-check results. Keep your documentation, receipts, and sources organized so you can update quickly when new guidance arrives. As we wrap up, thank you for watching. If this was helpful, please like the video, share it with someone who needs a tax tune-up, and subscribe for more practical planning content. In the comments, tell us your top 2025 move and any questions you want covered next.